My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Hello, welcome to Legacy Money, the show to help you live more, give more, and leave more. I'm your host, Barry Page, and in this episode, I'm going to compare infinite banking loans to traditional financing. And I'm going to share a real-life example of a policy that's in effect in loans and repayments. This video is not about paying a lower interest rate or getting a higher rate of return. It's about taking control of the banking function in your life so you can create more wealth for your family. So what we're going to be talking about is becoming your own banker. It's from the best-selling book by R. Nelson Nash. So I'm just rehashing some of the things that you may have already heard me say, but this is a quote direct from Nelson's book. Banking is the most important business in the world. And we advocate that privatized banking is the solution to the problem. So a question we get all the time is, what's the difference between compounding interest and simple interest? And really, at the end of the day, simple interest is better if you're paying interest, and compounding interest is better if you're earning interest. So what I'm going to try to do is just show you a comparison. It's hard to compare this, but and it's hard to get your arms around it sometimes as well. But I'm going to show you some real-life examples. I've gone to bankrate.com, which you can do on your own, and I've just figured out a loan amortization, and then I'm taking an actual policy that's in force. So I'm going to show you an actual policy statement, a letter to the policy owner, and an example of their loans and repayment schedule. So let's take a look. Before we make the comparison, I need to show you an actual statement from a policy that is seasoned. So before you can make a loan, you either have to have capital, you have to have collateral, or good credit. And so what I want you to understand is you have to save money to pay cash, or you have to have collateral to borrow money. And in this case, we are using our own personal capital. So this is a life insurance policy that is contractually paid up at age 95. It was taken out, the policy date as you see here, 2010, September 13th, 2010. There's an annual premium of $12,000. It's paid annual, and right now this policy has a outstanding loan of $122,244. We'll get more into that in a little while, and there was loan interest due of $9,055.17. Now this is actually the policy statement from 9/13/2020. So we're now in May of 2021, and you see that loan interest was due on 9/13/2020. And this person has set up an automatic repayment that drafts right out of his bank, probably like many of your accounts that you have now, and he's repaying $2,000 per month, $24,000 a year. Now, what this shows down here are the policy values in 2019 and in 2020. So in 2019, the cash value was $171,122 and some change. In 2020, it was $191,880.43, and that was on, again, 9/13. The death benefit at that time, and we'll come back to these, was $1,171,272. So this is the policy statement from 2020. Now we're in the middle of the year, so that's why I wanted to show you this first to kind of preface it. Now let's go back and look at traditional bank financing. So I went to bankrate.com, and I'm going to show you this loan amortization from them. As you see, May the 6th, 2021. Now, this is what it looks like in a spreadsheet. So these are the payments being repaid to the financial institution, the bank, traditional financing. Principal and interest are paid, right? And the interest portion is here. This loan is at 4%. You can see that this policy loan rate is 7.4. Now, you might be asking yourself, oh, why would I want to pay 7.4 whenever I can pay 4%? Very logical question to ask. And many loans with different companies are at different rates. The reason I want to show this one is because this is a seasoned policy and the loan rate is 7.4. So I just want to show you how it looks compared to a 4% traditional loan. But also, there's a lot of concern. I just had someone call me this week concerned that they had a direct recognition policy, and that's really deep in the woods. But this company is a direct recognition company. So I want you to be aware of that, and I want you to see that that's really not such a bad thing. The companies that tout their non-direct recognition, they have lower loan rates, 4 or 5% in some cases. And what I want you to, if you're caught up in that, I just want you to understand that it's all relative. So if you're paying a higher loan interest rate, you're also probably receiving a higher dividend because of that. And it's all relative, so I wouldn't get too caught up in all of that. All of the examples in Nelson's book were on the same type of policy that I'm showing you here with a direct recognition company. So it's not really about the company. It's about how you treat the policy. It does need to be a mutual company that has participating life insurance, but that's a whole nother conversation. So let's get back to what the traditional bank financing looks like. So here we had a loan of $130,353. Now, I know that's an odd number, but that's what the other policy balance was at the time. So I'm trying to show you an equal comparison over 12 months. So in May of 2020, a $2,000 payment would have been paid. That's how much interest, that's how much principal and interest, interest, and you add those two together to get the $2,000. All right? So you see the total interest paid, and this came right off of the spreadsheet from Bankrate, right? So you pay the loan down, the interest total at the end of the 12 months that was paid was $4,000. $24,000 was the total payment. $4,031.84 was the total interest paid, and the loan was reduced to $110,000. Obviously, the loan is not paid off. We're using a 72-month loan amortization schedule to make the numbers equal. Now, let's take a look at the infinite banking loan. Now, here's what's important to consider. There are no terms with this policy loan. In other words, the policy owner can set the amount of payment and the schedule that they want to pay. There are no hard set rules other than the interest rate, which is charged by the insurance company. And that rate goes to them, it all goes back into a pool, and that's how the dividends are paid. So the loan is actually collateralized with the death benefit of the policy. So let's take a look at the actual numbers, okay? So here is that same amount, $130,352.94, okay? And if interest were due, simple interest on that at 7.4%, $9,655.76. Now, that's not when the loan interest was due, though. The loan interest is only due once a year. It's charged in advance, and then it's reduced over the year. So this loan interest was charged in September, and then it was paid down throughout the year. So here in September of 2020 is when the actual loan interest was charged and due. I was just making an example up here so you would see what it's like. And you might think, well, man, if the loan interest is $9,000 and on that other loan it's $4,000, boy, that's a big difference, right? So there's two things with that. One, the rate is higher, and again, this is not about the rates, but also it is simple interest, where this is compounding interest. The 7.4% loan rate is charged, and then each month he's making this $2,000 payment, automatically comes directly out of his bank account, right? And each month the loan interest is refunded, because we're talking simple interest. And the company takes care of all of this. This is nothing that we have to do as policy owners. The company will do that. And the reason right here you see there's no loan interest refunded is because that's the last month of the year. That's when this policy renews. So it starts all over. So you see there in October, then he was refunded $139.99 that month, okay, towards the interest which is charged in the beginning of the year, but is not due until the following year. So you have a whole year to repay in any amount at any schedule that you choose, and the interest and the principal that is paid every month goes back into the policy. It reduces principal, right? None of that is going towards interest in this scenario. Every carriers are a little different, but in this particular case, all of these payments go directly to reduce principal, the $2,000 every month. And over here, it refunds or credits that interest due, so whenever you actually pay the interest, it's much less. So for this year, there was a total of $810.59 credited back to that $9,000, depending on where you want to take a look at it, right? So when this policy statement just came out for May 2021, April was the last month to make a payment. So let me show you. So this was the original policy statement that I showed you, right? And here is a letter that's sent to the policyholder each time they make a payment. Okay, this came right out of their banking account, and the loan was decreased, as you see here, and there's the credit. So if you go back here to that $59.99, that was the last month right there. You see the $59.99, you see the loan balance $105, and so there's the $105 is the loan balance, and there's $59.99 credit. So that was the last month. So there will be a correspondence every month or every time a payment is made, okay, because it will reduce the principal and then it will credit the interest. So this is what it also looks like. This is another month. I just took the first month there, 5/27/2020, the $2,000 payment, right? The loan at that time was $130,352, just like I showed you, 94. There's the $47.11. So it decreased the loan by that amount, $2,047.11, right? So there's the loan balance. So let's go back here to the spreadsheet, and you see that was the original loan balance, $130,352. There's the $2,000 payment, and then the balance after that of $128,305 and the $47.11 that was credited. All right. So let's look at what the policy actually looks like today. So I just took this screenshot today, 5/6/2021. There is still an outstanding loan of $105,233.23 right here, $105,223.23. And what's important to note here, you see net death benefit. Okay, so net is the total face death benefit minus any outstanding loans, right? And then there's also a net cash surrender value. So there's still $105,000 that could be paid off, $102 if he paid it all in one today, right? There's the loan interest that is owed. And as you see here, this is a direct recognition policy. Okay? Premium anniversary 9/13, taken out in 2010, right? So it's active, it's set up to repay this loan every month. Now, this is also taken today. It shows you that the face amount, the total, is $1,171,272, and the cash value, now this is the gross cash value, $206,992. The premium, $12,000. All right? So hopefully that's making sense to you. And what I want to do now is just kind of compare these back to back for you. All right? So we have to look a little further with what's happening with the policy. So there's a couple extra columns here that you don't see over here, because when you repay the bank, where does the money go? It goes back to the bank. The bank has the money. The bank is in control. The bank sets the rules. The bank sets the terms. And if you don't repay the loan, you know what happens, right? Your automobile gets repossessed. Your business has to file bankruptcy. Your home gets foreclosed on. So we don't want those things to happen. So here are those same numbers we just looked at. The current cash value on this policy, $206,992. The current death benefit, $1171,272, right? So what I want you to notice is that on the policy anniversary, September of 2020, that cash value was $191. Now it's $206. So how did it go up? Well, there's a couple things. He repaid the loan, and he also paid $12,000 premium, and the policy grew because of the policy dividend. So all of those things are at play here. I want you to notice as well, so the policy went up in value from $171, this is in 2019, to $191. So we paid a $12,000 premium, but the policy grew by $20,000 roughly. That's the difference between IBC financing and traditional bank financing, and how premiums and interest are paid. Again, with traditional bank financing, you're paying principal and interest back to the bank at the end of the loan. Maybe you have the asset, maybe the asset is decreased in value, maybe you don't. But with IBC financing, you still have the asset, because obviously you're the asset in this case. The collateral is your death benefit, and the policy is still in force. The policy is guaranteed to increase in value every year. And in this scenario, even though it looks like you were paying more interest, at the end of the day, that money all went back into the pool of capital and your policy grew. So that is a comparison of infinite banking to traditional bank financing using an actual policy and illustration numbers that I've just showed you. Thank you for joining me today. I hope you enjoyed the video, and if you did, just give me a thumbs up. Please be sure to subscribe to our channel and hit the little bell so you'll be notified when I come out with new videos. Please leave your questions and comments below, and I'll try to get to them in a future video. So thank you for joining me today. I'll see you in the next video.